Good morning. I'm Dr. Wilson Paul, Associate Professor, Dept.of Corporate Secretatyship of KCS Kasnada College of Arts and Science. Go through the journal entry that is required in the chapter Underwriting. Then there are two sets of entries passed in the books. One set of entries that is passed in the books of the company. Another set of entries that is passed in the books of the underwriter. Let us go through the entries that are passed in the books of the company. The first entry, for the shares subscribed by the public, which means the shares taken by the general public. For that, we have to pass a single entry which is bank account data to share capital account. Then, followed by that, for the liability of the underwriter, the next entry will be there. The underwriter account data to share capital. This entry is given for the net liability of the underwriter. Then, the third entry, for the commission that is payable to the underwriter. The company we are writing journal entry in the books of the company, which means here we are recording the liability of the company to the underwriter. To what extent he is liable to pay the commission. For that commission, we are passing this entry. Underwriting commission account data to the underwriter. Then, the net amount receivable from the underwriter. The company receives the amount then as a net amount, which means the underwriter is supposed to pay to the company for the net liability, and the company is supposed to pay to the underwriter for the brokerage. In return, so we'll subtract one from the other and find out what is the net liability, what is the net amount to be paid by the underwriter to the company. That is for that we'll pass the last entry, bank account data to the underwriter. So these are the four entries that will be passed in the books of the company. Next, let us see what are the entries that are passed in the books of the Now, let us go through the journal entry first. For the shares taken up by the underwriter, obligation, that is his obligation, his gross liability. The share in the company to the company's account. Then, net liability, in other words, gross liability or net liability of the underwriter, that's it, is the obligation. Then commission that is receivable by the underwriter from the company. For that, he'll be passing an entry called company account data to underwriting commission. So since it is an income, it is credited here. The underwriting commission is credited here. In the previous case, the underwriting commission would have been debited. Then the next entry will be passed in the books of the underwriter is the payment for cash in settlement, which means the underwriter has to pay to the company for his net liability. Normally, the net liability will be much more than the underwriter commission, which means the remainder he has to pay. Suppose, for example, the company is supposed to pay commission of 1,000 rupees, and the underwriter is supposed to pay the money of 10,000 to the company for his net liability. The net amount is 9,000 is settled. For that, we'll pass an entry here. Company account data to bank. Then, last entry. The share that is taken by the underwriter will finally be sold in the market. For that, they'll be passing an entry. If it is sold at a profit, P&L account data to shares or debentures. The money for the transfer, that is any profit or loss, whatever it is. If it is a loss, it will be debited. If it is a profit, it will be credited. That's it. Thank you. Example for this. We've taken a sum from this to solve how it is done. A company issues 10,000 shares of rupees pennies at par. The issue is underwritten by K and Co. for the maximum commission permitted by the law. The public applied for and received 8,000 shares. Give journal entries in the books of the company and also prepare balance sheet. Now, let us start with the journal entry first. We are going to prepare journal entry in the books of the company. So, we have to look from the company's point of view, everything. The first entry for the public subscription, we'll pass the first entry for the public subscription. The public applied for 8,000 shares, which means 8,000 into 10, 80,000. For that, the entry will be bank account data to share capital. Then, next entry will be the underwriter's liability. Actually, the company is issued 10,000 shares, out of which applied for 8,000, received is 8,000. The remaining is 2,000 is the net liability of the underwriter. For that, 2000 into 10 will be the net liability of the underwriter, that is 20,000 rupees. For which we'll pass an entry K and Co to, that is the underwriter name is K and Co, to share capital 20,000 rupees. Then the commission receivable are payable by the company to the underwriter. Then the commission here is exactly the 2.5% of the issue price. That is 10,000 share of rupees 10 each will give you 1 lakh. Out of 1 lakh, 2.5% is the law permitted limit. Out of 1 lakh rupees, 2.5% will give you 2,500 rupees. So that is the commission to be paid by the company to the underwriter. Now, the last entry, the net amount received from the underwriter, the company is. The underwriter is supposed to pay 20,000 rupees to the company. The company is supposed to pay 2,500 to the underwriter. Therefore, the net amount will be 17,500, for which the entry will be bank account data to K and Co. That is 17,500. So that is the entry here. Now, let us see how it is reflecting in the balance sheet. Now, the balance sheet shows the share capital of 1 lakh. That is the company issued shares. Then for which the cash received from the company, received by the company is 97,500 shares. And the 2,500 is nothing but the commission, underwriting commission. That is shown in the asset side of the company. Thereby, the balance sheet will tally with a total of 1 lakh on both the sides. So that is the end of the sum. Thank you.